Hi everybody, today I'm going to share with you the Singapore largest China-focused REITs, which is CapitaLand China Trust. Before I talk about the REITs, let's look at the sponsors. The sponsor is CapitaLand, which is actually one of the Asia's largest real estate group, which have more than 80 properties in China. And this indirectly may be able to help CapitaLand China Trust to propel for their next growth. And a lot of you will be aware that CapitaLand China Trust previously was called Capital Retail China Trust. And late last year, they have changed their mandate to become a multi-asset REIT. Then they will start to diversify from shopping malls to encompass other asset class such as integrated development, business park, or logistics facility. So this is their current asset, where currently they have 11 shopping malls and 5 business parks, mainly located in the Tier 1 and Tier 2 city of China. Tier 1 city will comprise more than 50%, with the main focus actually in Beijing and Shanghai. And Tier 2 city comprise about 40%. And we can see that their asset class diversification, retail will still be the main contributor, which contribute more than 80%, while the business park contribute about 19%. And however, do take note, they have just started to change their mandate last year. So we'll expect more acquisition going forward in the next few years, and we'll expect the retail weightage will start to come down, where we're able to see more other type of asset class will start to increase over time. And look at their financial information. Their total asset currently is about 5 billion, which is a pretty decent size REIT with the NAV of about 1.53 currently. And their gearing is 35.9, which is pretty healthy now. And also their interest coverage ratio is also on a healthier range, which is 4.4 times. It's way above the requirement set by MAS of 2.5 times. Let's look at their retail portfolio, where they have 11 shopping malls located across 7 cities in China. However, I just want to point our focus to their shopping mall, which about 50% of them is from Beijing. Thus, the performance of the shopping mall in Beijing will have a bigger impact to the overall REIT's performance currently due to the current weightage. One thing good about this REIT is that we can see that the occupancy rate have been increased quarter by quarter since last year, June 2020, while the current occupancy rate is 95.4%. So by looking at all these shopping malls, we can see that most of them are above 90%, except the shopping mall Qibao, which is in Shanghai, where the occupancy rate is pretty low, around 82.6%. However, do take note that the contribution for Shanghai currently is not even 1% to the REITs expect. So the impact will not be that big. And let's look at their new asset class they have acquired last year, which is the business park, where they acquired over 3 cities, total 5 assets. And since acquisition in last year September, their occupancy rate actually have been increasing from 91.5 to 94% currently. It is above the average occupancy rate of the business park in China. So this is a pretty good record for this mall. Let's look at the performance of these REITs. The assets have grown from 700 million when the IPO is in 2007 until today, where they have grown to more than 5 billion. However, when we look at REITs, our focus is not really on the asset growth. Our focus will be more on the DPU growth. So the DPU have started with only 6.72 cents in IPO in 2007, and currently based on 2019, it has become 9.9, which means the DPU have grown over 50% over time. However, do take note that the DPU for these REITs doesn't grow up in a straight line or go up exponentially compared with some of the other REITs in the market. In fact, actually the DPU have been like a roller coaster ride, go up and down. However, the DPU still increased about 50% over the 12 to 13 years period. Although the distribution income have increased by 10.6%, but do think that distribution income increase doesn't mean DPU increase, as the assets start to grow, and along the way they may have certain equity fundraising exercise, which will definitely result in higher distribution income, but the DPU may not increase. So this is something you need to take note of when you're looking at REITs. And a few months ago, they have announced their result for first half 2021, and they have said that they achieved the highest MPI growth since listing. Why they can have such a high MPI growth? First thing that we need to take note that it starts from a low base of first half 2020, and that's where during the COVID period, and also that they have expanded their mandate and they start to acquire business park, and this business park revenue have contributed to the MPI. So the highest MPI growth doesn't mean that the REITs have suddenly performed very well. It's just that they have the expansions of their mandate and start from a low base. But nevertheless, it's still a growth for the REITs. We want to look at, does this REIT have any growth potential or not? Now let's look at the price chart performance. Okay, we can see that the REIT since IPO at 2007, and then it start to move up, and it hit the high of $3.34 before the global financial crisis. After that, it have crashed about 90% down to only 40 cents. It has started to recover along the way, but up to today, we can still see that the REIT price is still 50% below their all-time high in 2008. Compared to some of the REITs, actually they have surpassed their all-time high in 2008. So by looking at the chart, it may don't look promising for these REITs. However, do take note, these REITs previously were called Capital Retail China Trust. So in the past, they are only purely focused on shopping mall. So that is the past record. We need to move forward and look forward is, and now they have become a multi-asset REIT, which the past price performance may not be really relevant to these REITs going forward. Let's look at their 2-year price chart, where their NAV is 1.53. Their current price is around 1.24, which is around 20% lower than the NAV value. And we look at their other REITs that is under CapitaLand sponsorship, okay, like Ascendas, CICT. Okay, CICT is trading around their NAV value, and Ascender REIT is trading above the NAV value. Escort REIT is slightly below the NAV value also, but because we know that hospitality trusts have been very affected by the pandemic. So when these REITs have changed to multi-asset, we may see that there is a potential for these REITs to trade above the NAV in the longer term period. There may be a potential upside for these REITs. However, you need to hold for a longer time horizon. Okay, let's look at the growth potential of these REITs, whether the price can have the potential to go above their NAV value in the mid-term. Since last year September, they have changed their mandate from a retail-focused REITs in China to be a multi-asset focused REIT. What does it mean? It means that they were able to acquire the various asset class, other asset class like integrated development, logistics, even data center, except the lodging China business. So this will mean that they have a lot of potential for them to grow and transform over time. We look at last year when they start to acquire the 7 business center, their AUM have grown, have a big jump in their AUM, and even you look at the AUM of the other 3 China focused REITs combined, actually now they are even smaller than this CapitaLand China Trust. And this is their 5-year plan. So we want to look at the REITs, see whether do they have a potential to grow and do they have the plan to grow. So we can see that currently they are more than 80% in retail, about less than 20% in the new economy asset where it's called a business park. They will plan to reduce the retail side to that 30%. I mean from an 80% drop, another 50% to 30%, where they'll increase the new economy to 30% and integrated development commercial to be a 40% asset. So to me, this is a growth strategy, and this is their 5-year plan to grow on that. This will be actually positive to the share price of these REITs. However, one thing need to take note is, as if these REITs will need to move in this aspect, we'll expect several acquisitions will be ongoing along the way. The REITs will grow over time, and thus we cannot rule out that there will be equity fundraising along the way also, in order for the REITs to transform from the current status to the new status, which is a 30-30-40 split. Thus, if you believe in the growth story of China and want to tap on CapitaLand expertise, you may want to look at these REITs to ride on the wave of the China growth over a longer term period. That's all I have to share with you today. And if you feel that this video benefit you, do remember to like and share this video, and also please do leave your comment below to let me know what you think. Do remember to subscribe and press the bell button so that you'll be notified on the next video, and I shall see you in the next video. Thank you.